President Trump's administration has signaled its intention to impose a 25% tariff on goods coming from Canada and Mexico, and a 10% tariff on goods from China. According to multiple reports, these tariffs are intended to pressure Canada to take stronger measures against issues like border security, drug trafficking, and illegal migration. Trump has argued that such tariffs would encourage domestic production and help address the large trade deficits the United States runs with these neighbors. Many analysts see the tariffs not simply as an economic tool but as a negotiating tactic. By threatening steep tariffs, the Trump administration appears to be seeking concessions from Canada, as well as Mexico, on border security and possibly on renegotiating aspects of the U.S.-Mexico-Canada Agreement, USMCA, that governs North American trade. In previous instances, similar moves were sometimes used to leverage better terms or to force discussion on issues that extend beyond trade policy. Canada is highly dependent on the U.S. market, with an estimated 20% of its GDP tied to exports to the United States and daily trade flows amounting to roughly $1.9 billion. A 25% tariff would make Canadian goods more expensive in the U.S., potentially reducing their competitiveness. Sectoral impact. Industries such as automotive parts, energy, including crude oil and refined products, agriculture, and even specialty products like maple syrup could be significantly affected. If the tariff burden is passed along the supply chain, U.S. consumers might face higher prices for products that are currently imported from Canada. Retaliation risk. In response to these measures, Canadian political leaders have repeatedly warned of strong retaliatory actions. For instance, Prime Minister Justin Trudeau and provincial leaders like Ontario Premier Doug Ford have signaled that Canada is ready to counterattack with tariffs on U.S. goods, a move that could further escalate tensions and disrupt cross-border trade. Consumer prices. If companies absorb less of the tariff cost and pass on the increases, U.S. consumers might pay higher prices for a variety of goods. This pass-through effect could lead to inflationary pressures in the U.S., with some estimates suggesting additional per capita costs running into the thousands of dollars annually. Trade disruptions. The tariffs may unsettle long-established supply chains. For example, U.S. manufacturers that rely on Canadian inputs might be forced to find more expensive domestic alternatives or shift production entirely, potentially reducing overall economic efficiency. Diplomatic and legal ramifications. Given that a large portion of Canadian exports is governed by the USMCA, unilateral tariff impositions could violate the spirit or even the letter of the agreement. This might prompt legal challenges and force a renegotiation of trade rules between the two countries. Canadian response. Government stance. Canadian Prime Minister Justin Trudeau has characterized the tariffs as unacceptable and has warned that Canada will respond forcefully if the U.S. follows through with the tariff imposition. There is talk of bolstering border security and even retaliatory tariffs on U.S. products to counterbalance any adverse economic impact. Provincial reactions. Leaders such as Ontario Premier Doug Ford have gone as far as suggesting drastic measures, threatening to pull U.S. goods, for example, American distilled spirits, from the Canadian market, which illustrates the high stakes involved in North American trade relations. Economic uncertainty. While some U.S. industry groups support tariffs as a means of protecting domestic jobs and industries, many economists warn that the overall economic impact may be negative. There is significant concern that such trade measures could hurt consumers, increase production costs, and potentially lead to job losses if the retaliatory cycle escalates. Negotiation tactic. Some market watchers interpret the tariff threat as a tactical move designed to force concessions from Canada and Mexico, rather than an indication of a long-term policy change. This view suggests that the tariffs may be phased in, limited in scope, or even temporarily exempted for key sectors such as energy. In summary, the proposed 25% tariffs on Canadian imports are a significant escalation in U.S. trade policy. They are intended to address issues like drug trafficking and illegal immigration while also pressuring Canada for tougher border security measures and potentially renegotiating aspects of the USMCA. However, the economic fallout could be substantial for both sides. Canada risks losing export competitiveness and facing retaliatory measures, while U.S. consumers might face higher prices and supply disruptions. The situation remains fluid, with many industry experts and policymakers awaiting further details on the scope, timing, and possible exemptions of these tariffs before the full picture emerges.